All right, one of the first substantive areas inside of our macro unit that we'll talk about is GDP. So, yeah, this is something you'll commonly hear, in the news and in the world around you. What does it really stand for? GDP stands for Gross Domestic Product. That is, it's the value of all the goods and services produced within a geographic region in a specific time period. So, value of all goods and services produced in a particular region, the geographic region, per time period. Now, how do we think about this? Well, let's look at this model that a lot of people start econ classes with, called the circular flow. I think it's most important right here at the beginning of macro. The circular flow model thinks about the flow of resources and payments inside of the economy. So the simplest version that you can find would be one that has firms and households in it. Okay? So the simplest version starts with just firms and households. Then as it gets a little more complex, you can add in other things. So let's look just at those outer parts, firms and households. Households pay money to the firms for goods and services. So firms supply goods and services to the households. Households pay money to the firms for those goods and services. Now, where do the households get the money? Well, the households sell stuff to the firms as well, and that's in the form of resources. So at the end of the day, who owns all of the resources? Well, those are individuals, and the individuals live in households. So you can say that Alcoa owns a lot of bauxite mines from which they make aluminum, but who owns Alcoa? Well, the shareholders, right? So at the end of the day, all of the ownership resides in the households. So households sell resources, as land, labor, and capital is our simplest way of thinking about it. Who owns the land? Well, the individuals that in some form own land. They own all they own all the machines. They own all of they supply all of the labor. So households supply resources to the firms, and they get paid. That's down here at the bottom: wages, interest, and dividends. That's you get paid for your labor. You get dividends, on your stock. You get paid interest if you loan money. You buy bonds from a business. So that's the outer part of the circular flow. You trade money for resources, and then you use that money to buy the final goods and services that the firms make. Then you can add in another element, that's government. Put that in the middle. That adds another, a wrinkle to this. And then you can even add in an external part for international trade. And households and firms both trade internationally as well, and that makes it even more complex. But what we're trying to do with the calculation of GDP is add up the value of all those final goods and services produced within your economy, within a geographic region in a particular time period. Now, what is it good for? Well, for one thing, it helps us make comparisons across countries. Where do people have access to more goods and services, right? Well, where they produce more. And so here's on this side over here, here's a map of the world that lists, it compares GDP per capita. That is the amount of output divided by the population. So that's GDP per capita, meaning per person. So take the total, divide by the number of people, and that shows you at least the average goods and services available per person. We're going to see that that's not always, doesn't always reflect what's available to some or most people. Why else? Looking at changes in GDP helps us identify business cycles, and that's another topic that we're going to talk about as well. The business cycle, sometimes the economy is expanding, sometimes it's contracting. One of the pieces of information that can help you recognize that is changes in the output. So, how do we measure output? don't know if you get the picture there or not. It's a way of measuring output, at least for individuals, perhaps in the hospital. It's not what we're talking about here. Here we're thinking about the two different ways that we could measure GDP. One is called the expenditures approach. This is the most common one. This is the one that we'll generally use, but I want you to also know that there is another approach, and that is the income approach. Both of these should give you the same thing, plus or minus some errors in measurement, right? But no matter how you calculate it, you should get the same thing. Here, the two approaches, though, get back to the circular flow. The expenditures approach measures how much money is spent on goods and services in the economy. The income approach catches it on the other side, how much money is spent by firms, paid to households as income, right, for labor, for resources, so how much is paid out in wages, dividends, and interest, for example. So the income approach tries to catch how much money are firms paying to households, for all of those resources that they own. The expenditures approach is trying to catch how much do households pay, to firms for the final goods and services produced. And then we added, and government adds another wrinkle into the circular flow, but then into the calculation of it as well. So for income, just understand you're trying to add up the value that is paid in essentially wages, dividends, and interest. Now, the way we're going to think about it mostly is through the expenditures approach, and that's adding up the value of all of the expenditures on consumption. On the all the expenditures on the final goods and services. And so the four categories that we use in this approach, we call it C plus I plus G plus X, right? Or NX, some people say. So what do they stand for? Well, consumption. So that's when individuals buy stuff to consume. Right? So if you buy, some sunscreen, right? That's consumption, right, of a good. If you buy food, when you buy new clothes, there's all sorts of things that represent consumption spending. So when households buy stuff, that's generally consumption. That's the C. The I is investment. And that's when producers buy capital goods, that is, goods that are used to produce other goods. So if I'm a Ford Motor Company and I buy a new die stamping machine, right, in order to stamp out fenders for the Ford Explorer, right, that is an investment expenditure. So household consumption, basically business investment, right? When businesses spend money on things that they're going to use to make other things, that's investment. The G stands for government spending. Now, this is government spending on stuff, right, on things. So if the Pentagon buys additional uniforms, right, for the military, that counts as expenditure, spending. If the Department of Commerce buys copy paper and pencils, right? That is government spending. Now, transfer payments do not count in here. So if, right now there's federal unemployment, there's extra federal unemployment money due to the coronavirus, right? There's an extra $600 a week available on top of state unemployment benefits. That is a transfer payment. That doesn't purchase anything, and so it doesn't get added up in terms of GDP, because that's money that's being transferred to households, which then they can use. Right? They might use it to buy food, to pay for electricity, to pay utility bills, to buy other things, and would get counted then. But at the transfer stage, it does not get counted. So government spending for goods and services gets counted. Government transfer payments do not. So that's the G, right? C plus I plus G plus X. That is net exports, right? Or you want to think exports minus imports. And this is a little bit of an accounting thing, right? It's to add up. What are we trying to get? We're trying to calculate the value of all final goods and services produced in a particular region in a particular time period. So often it's at the national level, right? So what's U.S. GDP? What's the value of the stuff produced in the U.S.? So we want to add on exports, right? So if we produce heavy earth-moving equipment that then gets sold abroad, right, to other places around the world, that represents goods that we produced, right, that workers in the U.S. produced, in a particular time period. So we want to add that on. We also want to subtract off imports because under these other categories, under consumption and investment and government spending, we added up what people spent on stuff. But if we didn't actually produce it here, then it shouldn't count in our GDP, right? So if households bought shirts that were made in Thailand, then we might have added that up as consumption spending, but it doesn't really count towards our GDP, so we net off the imports. So you're going to add on exports and subtract off imports. We just call that net exports. So if you're running what we'll call, when we look at trade, a trade surplus, then this would be positive. If you're running a trade deficit, at least in the capital account, as we look at it, that would be, and then net exports will be negative. And contrary to some popular, opinion, it's not necessarily horrible, right? If we're running a trade deficit in the, in terms of goods and services, it actually is, we make up for it somewhere else, right? It has to sort of come out in the wash. But at any rate, those are the elements that go into the expenditure approach to calculating GDP. C plus I plus G plus X. Now, a note here, we are trying to get at all final goods and services. So not just goods, right? Goods and services, but they have to be final in order to be counted. So why do we do that? Well, it's to get an accurate picture, right? To get the appropriate number, to essentially to avoid double counting. So a couple of caveats here. We do not count intermediate goods. When I buy a milkshake from Bill Gray's, that's a final goods or service, right? That gets counted. When Bill Gray's buys custard, the liquid stuff that goes into the machine to make the soft serve ice cream, when they buy, the custard mix, that does not get counted, right? Because that is what we call an intermediate good. When I buy the milkshake, when you buy the ice cream cone, that gets counted. That's a final good that we're purchasing. The custard that goes into making it doesn't get counted because it's not a final good or service. That's what we call an intermediate good. It's going to get counted, right, when they finally sell the ice cream cone or the milkshake. And if we counted it at an earlier stage and counted it again at the end, there would be some element of double counting there. Let me give you another example. If Ford Motor Company is buying a whole bunch of Bridgestone tires that they then sell that they install on cars, right? So on the Explorer before it gets shipped to dealers and sold, we don't count that. When Ford Motor Company buys tires, it's an intermediate good. When they sell the Explorer, that is a final good, right? When that consumers and households buy, and the whole value of it gets counted there. If we counted the tires and the windshield and the rubber seals and all the other parts that Ford Motor Company outsources, right, that they buy from other producers, we would be over counting the value, right? Because we would be counting the parts along the way, and we'd be counting them again as when they are assembled into the whole. So we don't count intermediate goods. Why? Because we want to avoid double counting. So we only count final goods and services. And we do not count used goods because used goods are not final goods and services produced in that time period. And why else? Because they've already been counted. Right? So used goods were once new, and when they were new and they were sold, they were counted in GDP. We're not going to count them again right when it's sold later. So if you buy something from an antique co-op, it does not get counted. Right? Now, strictly speaking, services added to it should get counted. So at some level, if somebody did a lot of work to clean up and polish and repair something, an antique, an antique desk, if it's refinished and repaired and, made beautiful and whole again, technically the services to refurbish it should get counted, but the rest of it, the value of the desk itself, would not get counted. Why? Because that was counted at some point in the past when it was new and first sold. It doesn't represent, the desk itself doesn't represent production of a good or service in this time period. Now, the repair or refurbishment of it does. So technically speaking, that sliver of it would get counted. It starts to get complicated, right, in the actual nuts and bolts of adding this up. But I do want you to understand at the conceptual level what's supposed to be counted, what we're trying to count. All right, some weaknesses in GDP measurement, right? It's not perfect. It's good, right? It's better than nothing. There are lots of things that it helps us with, but let's just say it's not perfect. And let's look at some of the reasons that it's not. GDP does not fully account for, or does not account for, household services or household production. Maybe that's a better way to say it. Let's call it household production. So whenever you go to the barbershop or a hair salon and you have your haircut and you pay for it, that's a market transaction. That's a service that's produced, and consumed, and that is counted. If you cut your own hair, somebody inside your household cuts your hair, it does not get counted. If you go out for dinner, right, or you buy takeout from a restaurant, that gets counted in GDP. If you cook dinner at home, it does not. Right? Now, the groceries do. When you went to Wegmans or Tops, or Aldi, and you bought the groceries, those got counted. Right? So those materials got counted, but all of the work that you or someone in your household put into preparing the food, right, to make a delicious dinner, that doesn't get counted. So, let's close that. Household production does not get counted, and that means that there's a lot of value that's produced that doesn't get counted. When you mow your lawn, when you shovel your driveway, when you wash your own clothes, when you wash your car, right? Those are services that you are producing, for yourself, and they don't get counted. If you go to Delta Sonic and pay to have your car washed, then there's a market transaction and it does get counted. So there you go. That's one way that the measure is off. 2, does not account for what we call under the table or black market transactions, right? So under the table, or we could call it black market. What we mean, illegal markets. So if you pay cash to someone down the street to detail your car, that doesn't, so some high school kid down the road and you pay him or her, right, $80 in cash, and they do a really nice job detailing your car. I bet they're not going to report that on their income taxes, right? So there's no sort of record of that transaction. It doesn't get counted. Those sorts of cash transactions, some babysitting, nannying, mowing lawns, things like that. If they are, individually to people, especially, kids that you might hire to do this, doesn't get counted. Illegal goods also do not get counted. So all of the value of street drugs, right, that are produced and sold in the U.S. do not get counted in GDP. And maybe there's a reason for that. Maybe we don't want to sort of encourage or count that, but it is in fact services or goods that are produced and then they are not counted. Now, what else? GDP does not fully account for environmental quality or sort of overall quality of life. Not counted in GDP. So having this example here, if we, if a factory is producing stuff, that gets counted at some point in GDP. If in the process of producing it, it creates a lot of environmental degradation, and then that later on we spend money to remediate that, that gets counted in GDP too, and that makes it seem like we're even richer, right? We have even more stuff, but maybe the fact that we polluted the environment in the first place is not such a great thing. And so that's one of the problems with how we add this up. Also, it doesn't account for leisure time, right, or the value of leisure. Now, whenever we, if you pay to go to a spa, right, that's a market transaction, where you're consuming, services, essentially leisure-ish services, that gets counted. But when you're, and this is this person, if you're sitting in the hammock in the backyard reading a book, that the value of that doesn't really get counted. So at the same time, that's not really the production of at least of a market good or service, and so maybe it's not terrible that it's not in there, but it is the case that we sometimes use GDP as a proxy for overall well-being, and to the extent that we're trying to use this as a proxy or an estimate of overall quality of life or well-being, we're missing some stuff. Okay? Similarly, GDP does not account for the distribution of income. So not everybody, when you look at GDP per capita, right, took the total GDP for a nation, divide by the number of, by people there, GDP per capita is not necessarily reflective of most people's. It can be, but it may not be. If you have a very, very unequal distribution of income, there are some incentive effects from that that are not all terrible, but there also are reasons that people are concerned about that, and it can be skewed. If you're trying to use GDP as an overall estimate of the well-being of individuals in a nation, it can be skewed if there is a very, very slanted distribution of income. So here are a couple practice questions. You may want to just pause the video here and look at this list and see what you think. And then we'll go over them together. So, all right, let's go over these. Remember, we're thinking about final goods and services, not intermediate goods. And just for fun, just to make sure we're on the right track here, let's think about whether they are consumption, investment, government spending, or net exports. Let's see if we can do a better job with that I. Not really much better, is it? C plus I plus G plus X. So, if you buy ice cream at Wegmans, does that count? Yes, right? That counts. And what kind of a good is that? That is a consumption good, right? Now, what if Wegmans buys ice cream? So when Wegmans buys, half gallons of Breyers or Turkey Hill ice cream, or when they buy ice cream sandwiches at Stockholm, does that count? No, right? Because that is an intermediate good. Right? Wegmans doesn't consume the ice cream. Wegmans is buying ice cream to resell to us as a final good or service. So when Wegmans buys ice cream, that's an intermediate good. It does not count. Now, what if Wegmans buys a freezer to store ice cream? Right? So those freezers in the store. Those do count. What kind of a good are those? Those are investment goods. Right? When Wegmans buys freezers, they're making investments into their business. Now, what if an individual buys marijuana? And then recreational marijuana is still not legal in New York. So just to make sure we're on the same page here, So we're calling this is an illegal, right, an illicit substance. So does it get counted? Nope. Right. Because this is a black market or under the table transaction, right? So we'll say illegal transaction. So it does not get counted. Now, what if New York buys road salt? Well, when New York buys road salt, right, they're stocking up for next winter already. If New York does that, then yes, that does count. And in what category? Well, that's government spending, right? That's government spending on goods and services. Now, what if New York pays unemployment compensation? No, right? That does not count because that is government is spending money, but that's not on goods and services. That's a transfer payment. Now, whenever someone who is in fact unemployed takes their unemployment compensation from the state and they use it to buy, to pay their gas bill or to go to Wegmans or to have repairs done on their car, then those transactions count in GDP. All right, what if I shovel the snow off my own driveway? Nope, does not count, right? Why? That is household production. When I shovel my own driveway, when I cook my own food, when I wash my own clothes, I'm producing a valuable service. Does not get counted in GDP. What if I pay the kid across the street to shovel the driveway? All right, still a valuable service being produced, but does not get counted. Why? Because that is an under the table transaction. Right, not recorded, not added up. Now, what if I hire a landscaping company to plow my driveway, a legitimate above board company to plow the driveway? Yes. Now that does get counted, and that is consumption. Now, what if I buy a used truck and plow from Auction Direct? Well, am I buying it just to consume it for myself, or am I buying it as an investment because I'm starting a business where I plow driveways? It doesn't really matter, right? Because it's used. So if I'm buying a used truck and plow from Auction Direct does not get counted because it is used, so it's already been counted. See how I tried to lead you down the wrong path there to say, well, is it consumption or is it investment? Because if I bought a new truck, then it could be either consumption spending or investment spending, depending on whether I bought it for me personally or is part of a business enterprise to start plowing driveways. And then the other sort of note or caveat here is, to the extent that Auction Direct spent resources cleaning up the truck, repainting the plow or getting it serviced, providing information to me about it, those services should technically get counted, right? But the truck itself would not, because it's used. It was produced years ago. It was counted when it was produced, in the previous, time period. It doesn't count again now. That would be double counting. All right, another important issue, and this is where some of the topics in macro especially are interwoven. And we're going to talk in a different section here about inflation and prices. But we need to mention it now because these things interweave a lot and we have to at least address it a little bit. Real versus nominal GDP, right? Or real versus nominal prices. Nominal is the number itself, right? The actual number, right? That's the nominal part. Real is trying to get some sort of consistent measure of value over time, right? So real means it's adjusted for price changes, in overall goods, or what we call inflation. So real means inflation adjusted. All right, well, what's inflation? We'll talk about that in a later period, but it's basically has to do with changes in the overall level of prices. So let me give you an example. When we were cleaning out some of my aunt's things many years ago, we found these these that belonged to my grandfather at one time. So he was a sawyer, and then a tenant farmer, and but this is from his sawmill, work. So you can see on these are like weekly wage envelopes. So I imagine he got paid probably in cash, but it was all recorded, legitimate business here. And if you look, you can see in this particular week that ended in May 4th, 1963, 40 hours of regular pay at $1.40 an hour and 10 hours of overtime at $2.10 an hour. So what is that? Time and a half, right? For overtime. So he made $77 that week. Then there's Social Security, old age tax, right? That's subtracted off, and then federal income tax withholding is subtracted off. And then you see what his take home was. But I want to talk about that. He made $1.40 an hour in 1963. So that is pennies, right? I mean, that's tiny. But how do we relate to that today? Well, it's a little bit hard to fathom. I mean, $1.40 an hour today, people wouldn't even roll over to get out of bed, right? I mean, it just wouldn't be worth it. But what was that worth then? Well, in order to make some sort of comparison across time, you have to adjust it for the overall increase in the level of prices, and that's what we call inflation. So, a measurement of inflation, what we're ultimately going to look at is the CPI or the GDP deflator or some other price index, helps us make comparisons across time to strip out the effects of inflation or changes in the price level. So that's what we're going for here. Another way to think about this is, like what you could buy from Sears. I know there aren't a lot of Sears stores around, but if you look on the website, you can still buy stuff from Sears. I had a professor in grad school who used to do this thought experiment and say, if you had $1,000 to spend at Sears, would you rather buy stuff from today or stuff from an old Sears catalog? So I have in my office a 1974 fall Sears catalog. Right? It's kind of fun. You can find other old stuff. You can find, here's a Sears motor buggy for $3.95. Here's a bicycle, some stuff. I don't have any more actual things with prices. So the question is, would you rather spend your $1,000 in the current Sears website or in an old Sears catalog? Well, the argument for using the old Sears catalog is that at those prices that are listed there, the prices will seem really cheap, right? You could probably get nice white linen dress shirts for a fraction of what they might cost now. At the same time, the style of those might be very, very different, right, than what we want to wear. $400 for a Sears motor buggy is probably a really great deal, but do I really want a Sears motor buggy, right? That's the question. Do I want the stuff that's available from these old catalogs? Is this the sewing machine that I want? Are these the clothes that I want? This is a motorcycle, right? This is a bicycle with an engine on it. Is this, it's probably a pretty heavy bike and a pretty weak engine, right? Is this really what I want? So these are the trades-off. It helps us make these comparisons, but it's not perfect because the quality and nature of the things that we consume and things that are available to us change over time. Even if you go back to the 1974 catalog, so it's not as antiquated as some of these things. When you look at the TVs, right? Would you want a TV out of the 1974 catalog? Some of them are in color, right? But they are big, boxy things. Clarity, not anything close to what we're used to today with HD and flat screen and big TVs. So it's not clear that that the changes in the price catch everything, right? There's also these changes in quality. All right, a few last thoughts here. Real versus nominal, right? We mentioned that. I want you to be aware of who calculates GDP. And it comes from the Bureau of Economic Analysis. So that's at bea.gov. Right, so I do want you to go fish around there a little bit. I listed this in the overall in the overview as well with the information on the different topics. The Bureau of Economic Analysis within the Commerce Department, they calculate GDP. They have tons of really awesome data on the website. So here I just pasted in the GDP by state. This is actually changes in GDP by state as of the third quarter of 2019. Now, whenever the data comes out the first quarter is out, but when the data comes out for the second quarter of 2020, it'll be really interesting to see because GDP has fallen, right? The value of all the stuff that we produced in the second quarter of 2020 will be way down. Here it is over on this side, broken down by county, right? So you can zoom in here, you can look at tables with actual counties. It's pretty interesting stuff. You can just fiddle around in here and see what's available. There you go. That's GDP. I said final thoughts is a little misleading. There's still a couple things to talk about. One is inventory. So you should just make a note here. You have to add on net changes in inventory, because what we're really trying to capture with GDP is the value of final goods and services produced. So things that are produced and things that are sold, like it doesn't happen simultaneously. Sometimes things are produced and then they sit in inventory for a while before they are sold. But we want to capture things that are produced in that time period. So we're going to add net changes in inventories. Okay. So again, if Ford Motor Company is making cars, if their inventory of cars that are produced but not yet sold goes up, we add on that net change. Why? Because those are things that if over a particular quarter net inventory goes up, that means we've produced more than we have sold out of inventory. We've added more to inventory than we've sold out of inventory, and that increase in inventory, right, the net change in inventory should be added to this GDP. On the other hand, if inventory goes down, so if they are selling cars out of inventory that they haven't replaced, then that should get subtracted off, because those cars got counted, right, when they were consumed, when they were purchased, but they weren't actually produced this period. They were produced in some previous period and held as inventory, and so they shouldn't be counted in this period. So this is basically another place where you have to be careful about the accounting in terms of actually adding this up. So you want to add on net changes in inventory. One or two last things here. GDP, gross domestic product, is what we'll almost always use, but you should be aware that there is another measure. It's a little bit older and not used as much, but this is gross national product. And it's very similar, but it's a little bit different. So GDP, gross domestic product, that is everything produced inside a geographic area in a particular time period. So it's everything, let's say for our purposes, produced in the United States, or produced in New York, or Virginia, or California, in a given time period. So per year, or per quarter, or per month. Yeah? That's GDP. That's what we've been talking about. GNP is the value of all goods and services produced by the citizens of a particular country. And so if there are U.S. citizens who live and work abroad, technically the value that of what they produce should be counted in our GNP. Similarly, things that are produced within the borders of the United States, but not by U.S. citizens, right, to the extent that some of the value of the goods and services is produced within the U.S. is not produced by U.S. citizens, it should not be counted in GNP. It would be counted in the GNP of the nation whose citizen produces it. And so that's where there's a fine distinction there. At the end of the day, they're actually very similar, because the vast majority of the production within the U.S. happens by U.S. citizens, and the number of other people in the U.S. and U.S. citizens other places tends to be fairly small in the grand scheme of things. Nevertheless, there is that distinction there. You should be aware of that. One last thing, I just want to sort of expose you to this. We will come back to this again when we talk about inflation. But the GDP deflator is an example of a price index, and that's how you can make comparisons over time. So here we have nominal GDP, that's this first column, in these different years from 2012 to 2016. And the nominal GDP is going up. You see that in the 2012, 2014, 2015. But then the question is, how can you make a comparison over time? How can you compare in real terms, separate out the effects of inflation? How can you make a comparison with output in 2012 and 2014 or 2015 or 2016? So the way that you do that is you take so basically the nominal divided by real has to equal the price index, or the price index in the current year versus the price index in the divided by the price index in the base year. So, but the way we usually do that, the base year, the way most price indexes are set up, the base year is given 100, right? So this is the base year. And so we call the index number for that year 100. And so in the base year, the nominal GDP and the real GDP are the same. Right? So nominal divided by 100, would give you, well, divided by 100 times 100 technically, would give you the real GDP, and that's the same. So let's look at one that's more interesting. In 2013, if the GDP deflator is 110, that is, if prices went up 10% from the base year to the year we're talking about, which is just a year later. So this increase in the index from 100 to 110 suggests that prices went up by 10%. And so basically, nominal over real should equal 110 over 100. Right? So you get that increase. So the question is, if the real is so real is 215,000, right? So the nominal is what we're searching for. We'll call that X over 215 has to equal 110 over 100. Okay? So if you take basically 215 multiply by 110 and divide by 100, that would give you the nominal GDP. So 215,000 times 110, and then technically we'd have to divide by 100, right, to keep it even. I get 236,500 for nominal GDP. And notice that nominal, if you have positive inflation, the GDP deflator is going up, then the nominal value of GDP should be going up faster than the real. Right? So if the nominal went from 210 to 236.5, but if all prices overall went up 10%, then real GDP has only gone up from 210 to 215. Okay? Let's do one other, and then you don't have to do this whole thing. We're going to circle back to this in the inflation section, but I just want you to sort of see this and be aware of it. If the nominal to real, so you could look at this different ways. You could say, well, I could adjust. I could look at how much the price went up and adjust by how much the real output went up. That's another way that we could do it. But if the nominal is 260 and the real is 220, then what is the price index? Well, if I take 260,000, I'm sorry, I meant to put, yeah, and then divided by 220,000, I get 1.18. Right, so that means, and so technically it has to be the new price index over 100. So if I multiply by 100, then I'm going to get 118. And that fits in here, right? That would suggest that from so from 2012 to 2013, the GDP deflator went from 100 to 110. From 2013 to 2014, it went from 110 to 118. So it went up less than 8%. Right? You have to do the math to figure out exactly. So the nominal GDP went up from 236.5 to 260. But that means the real GDP also went up, but this time again by only 5,000 in real terms, right? Once you take out the effects of inflation. So you can fiddle with those other ones if you want. I just want to sort of give you a preview of what that will look like so you can see where we're headed when we get into the inflation section. But that's it. That should wrap up GDP. So if you have questions, make sure you check in. Make sure you also have the written resources, right, as a backup. That's all in Blackboard as well. And